Starbucks unveiled an update to its reinvention plan. The coffee giant plans to implement a $3 billion efficiency program over the next 3 years, $2 billion of which will be saved outside of the store. Now, through this updated plan, the company expects long-term sales growth of 5% or greater, revenue growth of 10% or greater, and earnings per share growth of 15% or greater. Here to discuss that and so much more is Starbucks CFO Rachel Ruggeri. Rachel, so great to see you in person. Thank you so much for being here.
Thank you. It's great to be here.
So first, sort of break down for us how exactly you plan to work with employees, producers, as well as others to meet that $3 billion goal, and how are you going to measure success of that?
So the $3 billion is broken really into two areas. The first area is in our stores. And we've already, this past year, seen great progress on our reinvention plan, which was all about creating a more sustainable, what I'd say, efficiency level in our stores. And that was through the investments we made in partners and training, as well as wages, as well as investments in new store equipment and enhancements. All of that helped support a more stable environment. Our turnover went down, stability increased, and it allowed us to better serve our customers. And that was evidenced in, we had very strong out the window times, as well as it led to margin expansion and earnings growth. As we look towards that $3 billion, $1 billion more will come out of what we call in the store, which is the store operating expense. And that's largely around further improvements in staffing and scheduling, making sure our partners have the hours they need, but more importantly, in the right day parts.
Right.
So if you go to the store in the morning and it's super busy, it might mean that that store needs, more labor. Labor overall, our hours are good on an overall basis, but by day part is where there's a lot of opportunity and meeting our partners' preferences in doing that. The remainder of the $2 billion is largely in cost of goods sold. So things like in ordering our inventory more efficiently, using automation for that helps support reductions in waste.
Right.
Using our scale to buy more value in our as we source our products, that will give us opportunity to reduce cost of goods sold. And how we'll measure all of this, the efficiencies, it allows us to continue to invest back in the business.
Right.
So for this year, we'll see maybe about $1 billion in efficiencies, and we're investing back nearly $1 billion.
Right.
And that will allow us to use our sales leverage and things like strategic pricing, which includes mix, customization, attach, to drive progressive margin expansion in the future.
And let's talk about that consumer here in the U.S. We're seeing the return of student loan repayments. We're seeing higher interest rates. Are you seeing any pushback to these higher prices? And how concerned are you that there eventually will be a pushback?
There's definitely headwinds in the environment, but as it relates to Starbucks and our customers, we had another quarter of record demand globally. So our fall launch really resonated with customers across the globe,
right,
and it led to record level demand.
Do you plan to increase prices again in the near future?
We don't see pricing. Pricing will be in the more historical levels. Where we see a pricing opportunity is through an increase in how we customize our beverages, or how our customers customize beverages, how we drive attach. We had another quarter of record food attach. That helps drive a higher ticket, as well as being able to have more premium beverages.
Right.
So the combination of that, what we saw in this quarter was we had the highest average weekly sales we've ever had in our U.S. business, our largest business. And that was underpinned by growth both in traffic as well as a higher ticket.
Right.
And a good portion of that ticket, over 50%, came from greater mix, customization, and attach. So as we continue to drive digital capability, as we continue to innovate, and as we continue to offer channels of convenience, we believe that will help our momentum even in the year ahead.
And I do want to hit on your real estate portfolio. You have locations in California. You recently closed 7 stores in San Francisco. We're going to see a minimum wage increase to $20 in April. How do you plan to mitigate that cost, and could we see more store closures there?
I would take that in 2 ways. Of the store closures, that's part of our normal ongoing quarterly process that we have. We look at our stores across our globe and make decisions both financially and strategically regarding closures. So that's part of a normal closure process. We remain committed to our markets, committed to our businesses, but there will be an ongoing normal aspect of closures that we do every year. It's quite small in the scheme of things. As it relates to the California, the FAST Act and the wages, we're still evaluating that. But with the guidance we've given, we believe that the spectrum of risk is wide enough that it allows us to leverage our broad and diverse portfolio and balance levers to be able to fuel our growth.
And bringing it to China real quick, other competitors and other food chains tend to go there and approach it as a franchise operated model. You guys plan to stick to a company owned model. Why does that make sense? And will you ever consider licensed or franchise stores in China?
Well, I would start with the fact that we always evaluate our ownership structures, and we'll always do that. But today, as it relates to China, we believe a company operated model works best because it supports the level of growth that we know is possible. We see the opportunity in the overall market, and we can drive that opportunity better ourselves. So that's why we've chosen the company operated route. We have a great omni-channel business, which allows us to serve more occasions and a more diverse customer base. That's new over the past couple of years. And you couple that with the incredible experience our partners create and the innovation we can create in very local, relevant product offerings, that allows us to be able to see quite a bit of opportunity in China, and we meet that through the business model and structure we have today.
And Rachel, just really quickly, bringing it back here to the U.S., we can't stop hearing about the potential impact of weight loss drugs.
Yes.
Are you guys planning for any potential impact there?
What we see is that what we offer at Starbucks is choice. So we have a lot of different options in terms of, I, for example, order a quad espresso every day. Some people go for a more decadent beverage. Caramel Wall, I just learned about as an example. So we believe choice is a path for us, always has been and always will be. But as it relates to our business, we're seeing record demand. Right. So we aren't seeing an impact from, all of those different, I'd say, pressures that we're seeing otherwise in the market.
Rachel Ruggeri, always so great to see you.
Thank you.
Starbucks CFO, thank you so much for joining us.
Thank you.
All your markets, action ahead, live from the Nasdaq MarketSite. Stay tuned. You're watching Yahoo Finance Live.